Hello, so this instructional video is about funding intragovernmental business in the DoD when one organization does work on behalf of another, and there may be some financial implications related to that. We're going to start by talking about reimbursable transactions, and they come in two types: project orders and Economy Act orders. After that, we'll talk about non-reimbursable transactions that involve some financial consequence. We'll talk about the direct citation of funds and budget-based transfers. And then after that, we'll introduce the working capital fund, the concept of a working capital fund. These are activities that get no direct appropriation but earn all of their budget authority by providing goods and services to other organizations. And they come in a couple of different forms, industrial funds and stock funds. And we'll talk a little bit about how they budget, since they don't get an annual appropriation. So why do we have these reimbursable activities, or these reimbursable transactions, right? It's because no command, no program is entirely self-sufficient. Probably the most self-sufficient thing we have in the Department of Defense is a submarine out on patrol. But the minute it comes back to port, it needs help. It needs tugboats. It needs repairs. It needs supplies. And so an activity or an organization that lacks in-house expertise or lacks an asset requires support from somebody else. So let's look at some examples of this. A program office hiring a research and development organization to provide engineering support or logistics support for that program. Operating forces send equipment to a depot for overhaul. A ship or a squadron requisitions parts from the supply system or DLI. Or you have a tenant activity sitting on an installation and there is a host-tenant agreement. All of these are reimbursable transactions, and we have a customer-supplier relationship. It's almost like a contract, but a little bit different, because both parties to this contract are government entities. And we do this because organizations should focus on their core mission, and we can outsource some non-core functions to other organizations that have the capacity and for whom that function might be core. So let's talk about how these reimbursable transactions work. In the first step, the buyer and seller enter into a mutual support agreement, something like a memorandum of agreement or an inter-service support agreement. Second, both the work to be done and the funding need to be documented. And you may be familiar with the concept of a MIPR, a Military Interdepartmental Purchase Request, which would be this type of documentation, a statement of work and a line of accounting to pay for that work. In the third step, the buyer needs to comply with the necessary expense rule in terms of the use of their appropriations. So their statement of work needs to be for something they're allowed to buy. The supplier, in performing that work, needs to comply with that statement of work. So if I, the buyer, am providing O&M money to the supplier not only has to follow the rules of O&M, they're further bound by what was described in that statement of work. They can do that and no other, unless they come back and seek additional permission from the buyer. In the fourth step, the supplier is going to determine the basis for reimbursement because they understand their cost structure, right? And they're going to figure out what the estimated charges are. And the costs could be negotiated on either a fixed price or an actual cost basis. Fifth, all customer funds have to be accounted for separately and kept separate from mission funds and other reimbursable funds, because they're typically coming from different appropriations, and the seller, if they have multiple customers, needs to honor the reasons why Congress appropriated that money. And so they have to keep those funds separate. If I borrow a little money from customer A to subsidize what's going on for customer B, I have inappropriately spent customer A's money. Sixth, we have what's called the 51% rule. The supplier must do a substantial portion of the work. We don't want to use these reimbursable transactions simply to launder money. through the department. And so if the supplying organization is not going to do a substantial portion of the work, they should not be accepting the job. It should be structured in some other way. Seventh, for recurring support, services and costs are typically reviewed on an annual basis and modifications are made bilaterally. And finally, when the seller accepts the work submitted by the buyer, at that point, the buyer's funds are obligated. But the government as a whole isn't obligated to any private entity. We've simply obligated ourselves to each other. And so what happens here is the seller will then see an increase in their obligation authority so they can incur obligations using the buyer's funds. And it's not until the seller does work, incurs obligations and expenditures, that the buyer will then begin to see their funds expend. So the basic reimbursement policy is that direct costs incurred in the performance of the work, the service provided or the materials provided, shall be reimbursed unless the performing activity received appropriated funds directly for that purpose. So I'm at the Navy Postgraduate School. We have a mission-funded appropriation to do graduate education for naval officers. That would be Navy and Marine Corps officers. So if a naval officer came to NPS, we should not be reimbursed for that because we receive an appropriation for that work. But if an Army officer came to the Naval Postgraduate School or a DoD civilian, we should be reimbursed for the direct costs associated with providing that education because we've not been funded for that. If we were to do otherwise, we would be penalized because our funds would be used to finance a benefit to another organization. And that other organization's appropriation would be improperly augmented because we've provided things for them they didn't pay for. And so we have this rule in place to prevent violations of the purpose attribute of appropriations. A big exception to this rule are the working capital funds because they don't receive an appropriation. So they not only can be reimbursed for the direct cost, they need to be reimbursed for indirect and overhead costs. Let's illustrate this with a kind of silly example. I'm down the street from the Defense Language Institute. They receive an annual appropriation to do education in foreign languages. So their appropriations, say, is limited to their budgeted training plan. The training plan does not include teaching people how to speak the language of Fiji. But there's a DoD mission to Fiji, and they need to teach 20 people some rudimentary language skills in Fijian. So this is something that could be reimbursed. So I'm going to list a set of costs and think about whether or not these costs can be reimbursed in light of the fact that the Defense Language Institute does receive a mission appropriation for education in general, just not education in Fijian. So the first cost category would be faculty salary. Let's assume 240 hours at $60 an hour, $14,400. Ask yourself, would this expense be reimbursed? Now, in addition to the faculty salary are faculty benefits. For each hour that faculty member works, they're earning some leave, they're contributing to their thrift savings plan, and there's some matching by the Army for that. The Army may be helping subsidize their health insurance. So let's say there's a 35% acceleration rate on the basic salary. Is that reimbursed? Is that a direct incremental cost of supporting this class? What about wear and tear on the classroom? Can the Defense Language Institute charge this customer some amount of money, say $250 a week, just because people are walking on the carpet, sitting on the chairs, using the tables, writing on the whiteboard? Fourth, what if they bring in a guest speaker to talk about the culture and language of Fiji? Can we be reimbursed for the cost of the guest speaker's travel and their payment? Fifth, what about instructional materials? Books, supplies, worksheets, those sorts of things. And finally, what about overhead? This is a school, so they probably have a library, that's a command, they have a public affairs officer, there's a police force that's checking IDs at the gate, there's janitorial work that needs to be done, groundskeeping work. Can we allocate a portion of those expenses to this customer? I think about that for a minute, and then we'll look at the answers. So if we think about this idea of what is a direct and incremental cost, a cost that otherwise would not be borne by the organization, what we find is the classroom wear and tear should not be reimbursed unless there's some unique wear and tear on that room other than ordinary classroom activity. Ordinary classroom activity should already be considered and built into the budget for the school. Also, those overhead costs. Unless this course requires an additional librarian or an additional member of the police force, which is highly unlikely, it's only 20 students, and I don't think they'll be that misbehaved, then these costs are already covered. They're already included in the mission budget. There's not an incremental increase to the expenses associated with some of these tasks. But the faculty salary, the benefits that they earn for those hours that they work, guest speaker, instructional materials, absolutely, these would all be direct and incremental costs associated with delivering that course. Okay, in the introduction I said that there are two types of reimbursables, project orders and Economy Act orders, and the type you use is a function of whether or not the task is severable or not. And a task is considered severable if it can be broken into two or more parts, each of which meets an independent need of the government. Classic examples of severable services include things like groundskeeping or janitorial. Once the grass is cut, the need has been satisfied. Now, about 2 weeks later, the need may reemerge as the grass grows again, and we'll typically write an annual contract or so for groundskeeping. But theoretically, we could write a separate contract every time the grass grows. Every time the grass is cut, the need is met, write a new contract in a couple of weeks when the grass grows again. Similarly, we could write a new contract for janitorial theoretically every day. They cleaned the restroom last night, need satisfied, bathroom gets dirty again tomorrow, need a new contract. Now, we're not going to do that for efficiency reasons and economy reasons, but that gives you an indication of what a severable task might look like. I can break that work up into smaller pieces. One way you might think about it is, if I stopped work in the middle of the contract, did the government get value for what occurred up to now? Yes. Okay, so it's a severable task. A task is considered non-severable or entire if it cannot be broken up into parts like this. So an example would be to overhaul an aircraft, or perform a study and issue a report, to repair a broken pump, perform a test. What you need in these cases is a ready-for-issue aircraft or pump that actually works. A half-repaired pump does the government no good. Performing a study without the report of the results of the study or the reports of the result of the test does the government no good. And so those items we would fully fund as non-severable or entire tasks. So these things that are definite and specific, non-severable tasks, we would fund on a project order. We fully fund them at the time of the order, and those funds are available to the supplier until the task is completed, even if that task continues into the following fiscal year. In contrast, the severable tasks are funded on an Economy Act order. for routine recurring services, severable tasks, host-tenant agreements, groundskeeping, those kinds of things, right? We would incrementally fund these at the time of the order, and when funds expire, work has to stop. So these do not continue on past the end of the fiscal year. A new order would need to be placed at the beginning of the next year. Let's look at these reimbursable transactions as a process flow. And we can think of money as being analogous to water flowing through a plumbing system, right? So I'm going to use a mechanical drawing here that looks like a water system, but it's money. We start with a mission-funded organization that receives an appropriation for its mission and fills up a tank with appropriated dollars. They use these appropriated dollars to pay for the mission work that they do, the things that Congress intended for them to do when they provided that money. So there's the direct mission work, and then there's some overhead expenses associated with just running an organization, right? The commanding officer's office, the comptroller, the lawyer, the public affairs officer, and those kinds of things. And then you have a customer who wants to buy services from this mission-funded organization, and they're going to supply a project order or an Economy Act order. That mission-funded organization is then going to incur costs to do work on behalf of that customer. And as they incur costs, do work, they're going to bill against that customer's account. They will have set up a separate checkbook, if you will, of funding directly supporting that customer work. And remember, we have to keep these checkbooks separate. But notice that the total obligation authority, the TOA, for this mission-funded organization increased because they now not only have their appropriation, they have the funding that the customer gave them. Now, occasionally, you will find this work might be blended. So let's look at an example of a Navy ship and a shipyard. Shipyards are mission-funded by the fleet, and that mission funding is principally there for repairs to the ship. But we take advantage of the ship being in the shipyard to do modernization of the ship. And modernization of a capital item is typically paid for out of a capital account, out of a procurement account, shipbuilding funding, managed by the program office at NAVC. So we would have reimbursable funding coming over to the shipyard to support the work of modifying that ship, improving that ship, using shipbuilding money. Meanwhile, we've got O&M money from the fleet to do the repairs to the ship. Now, the ship may be indifferent as to who's paying for what, and they just see a list of tasks that are going to be accomplished. But behind the scenes, they may be funded through two different mechanisms, one being the direct mission funding, the other being the reimbursable funding. Now that we've talked about reimbursables, let's talk about something that looks a little bit like a reimbursable, but is fundamentally different. Reimbursable funds are picked up on the supplier's books and increase their total obligation authority. But we've got this other thing called a direct citation of funds, that when the supplier accepts those funds, they're not taking them up on their books. They're spending those funds directly out of the buyer's account. So one way to think of it is, let's say I'm running a small business and I did a reimbursable transaction. You pay me, as I'm the supplier, you're the buyer, you pay me, I deposit the money you gave me into my corporate account, and I pay myself out of my corporate account. If we did it as a direct citation of funds, you would give me a check that says pay to the order of blank, not to exceed a certain dollar amount. When I go to pay myself, I fill in my name on that line. I cash the check. I've spent money directly out of your account, and I never put it in my corporate account. Now, why would we ever do this? In the DoD? Well, there's a couple of reasons why we might do this. Let's say that you are traveling to support another organization. If they send a reimbursable, they would have to estimate the cost of the travel, send a funding document to your command. You would pick it up on your books, you would travel, you'd get reimbursed, then any difference between what they estimated and what you spent would be sent back to that organization. Well, that's basically 3 transactions: sending money, the travel, and then giving money back, giving any balance back. Why not just do 1 transaction? And so that organization could provide invitational travel orders, provide the line of accounting, you travel on their line of accounting, we don't have to mess with the finances of your organization. So that's one reason we might do this. Another reason we might do this is I'm sending money to you because I need to access a contract of yours, or you provide contracting services for me. I'm going to give you a little bit of reimbursable money to pay you to write this contract or modify this contract, but the money going on the contract, I'm going to give to you as a direct citation of funds. You're just going to put my line of accounting directly on that contract. This is also a way to deal with a potential 51% rule violation. Remember, if you accept a reimbursable, you have to do at least 51% of the work. Well, let's say you're interested in doing this reimbursable, but you have to outsource part of it. And you're concerned about maybe bumping into this 51% rule. So you could ask for the funding to be split into 2 pieces. One piece is the reimbursable piece that you do directly. The other part would be a direct cite that you put on the subcontractor that you're going to hire to help you do the work. This way your reimbursable is going to be close to 100%. And the direct citation is a way to avoid that 51% issue. So let's look at a direct citation using our mechanical drawing. So again, we have the mission-funded organization with an appropriation to pay for their mission-funded expenses. The customer comes and says, I would like you to help me, but I want you to spend the funds directly out of my account. So the customer takes their appropriation, provides a direct citation of funds. The mission organization puts the funding on some contract. Customer work gets completed, and it does not add to the total obligation authority of the mission-funded organization. Now, one big difference here, or another difference, right? What the main difference is the obligation authority does not transfer to the supplier. But in this case, the obligation does not occur when the work is accepted. The obligation of the customer's money does not occur until the contract is signed. And so doing it this way may slow down the pace of obligations for the buyer or the customer, but they get more visibility into what's being contracted. So that's the trade-off. Slightly slower obligation rate, but improved visibility of the transactions that are occurring. Now, there's a rule out there that says that an organization shouldn't do business with itself. There's no need for any entity to contract with itself. It has full authority to spend the money as they wish. So an organizational element that needs support from another organizational element who are both funded out of the same account should just simply move the money in the budget. So one example, I'm a professor in the Department of Defense Management at the Naval Postgraduate School. I occasionally teach courses in programs run by the Operations Research Department. We simply adjust the internal NPS budget accordingly. The OR department doesn't have to hire me from the Defense Management Department. We just realign the funds. Similarly, you have a ship, needs a new part. One's not available in the supply system. Another ship has that part. They provide it to them. You're not going to contract for that. You can reimburse the ship who gave up the part by simply adjusting money in the budget. Right? So how does that look using our mechanical analogy? So we've got a master account here, an appropriation for a mission that funds multiple organizations. Some of that money goes to organization A, some goes to organization B. They use that money to do the work of the organization. Now, let's say that A needs to receive services from B. Rather than doing a reimbursement, we just simply take a little bit of A's money, their obligation authority goes down. We give it to B, their obligation authority goes up. B does a little bit of work for A. So this chart compares the four mechanisms that we've talked about so far. The two reimbursable mechanisms, a project order and an Economy Act order, the direct citation of funds, and the budget-based transfer.